Noobs. This is the first video in a new series I'm calling Dear Derek, where you guys ask me whatever you want and I spend an entire video answering my favorite question. Runner-up questions get short answers and stupid questions get stupid answers. If you have questions, don't worry, just put them in the comments of this video and maybe your question will make it into the next one. So without further ado, today's number one question didn't actually get the most likes, but it's been asked multiple times in previous comments. David Loveridge asks, how do you raise capital for projects without having the land to do the project? Like, how do you raise money for a conceptual project? Fundraising is one of the most significant parts of the job of a real estate developer, and you have identified the chicken or the egg problem. You need money to buy the land, but you need a project to raise money. So what comes first? Well, it actually doesn't matter, but they both have to be in place at closing. I've gone hunting for deals with capital lined up, and I've gone hunting for capital with a deal lined up. So let me start by addressing David's scenario, raising money for a project that doesn't exist yet. Let's say I'm a potential investor, David. Let me ask you two questions in return. Without a property in mind, what am I investing in? And why should I invest in you? If you're really good at answering those two questions, you'll be able to raise capital from just about anyone. Sounds so simple, yet so difficult. Let's break it down. What am I investing in? You have to have a solid business plan in mind with a clear path to the returns you're projecting. Break down the business plan to a set of property criteria that you or your brokers can easily search for. Maybe it has to have as-of-right zoning with utility hookups in place. Or maybe it needs an existing residential building delivered vacant. Find the right balance between flexibility and strict criteria so it's actually possible to find what you're looking for without stretching your business plan to a breaking point if it's missing some criteria. And when you find a property that fits, you can plug its attributes into a pro forma template or a design template and quickly generate a model of its returns. Your business plan has to be compelling enough to beat all the other pitches your investor sat through, or at least pass a quality threshold if they're deploying capital across multiple investments. So you need to explain why your risk-return profile is better than any other opportunities and why your investment fits in their portfolio. You're pitching a business model and assembling the pieces as you raise the money. I say pieces because land is not the only piece, even though it's the biggest one. You have to assemble the entire team too, like your GC, architect, designers, and engineers. Which leads to the second question you need to answer for your investor. Why should I invest in you? Your business model is largely dependent on you. Your ability to execute, and therefore your track record, are how investors gauge the reliability of your projected returns. If you have an awesome business model but no track record, why should an investor trust you with their money? You have to convince them that things will go to your plan, or within an acceptable range of scenarios, and you have to have the experience to safely manage the project to completion and exit. Take it a step further. Why are you uniquely qualified to execute your business plan? Do you have an unfair advantage to carry it out? In Silicon Valley, VCs call this founder market fit. Here's how Yuri and I answered the two investor questions. First, what are they investing in? YD Development provided the opportunity to invest in co-living buildings in its early stages. We created a concise and repeatable business model around it and knew exactly what to look for. As a matter of fact, I shared my secret co-living formula in this video. The simple pitch could be given in one sentence. By increasing density in a free market multifamily building, we could charge lower rents per person but yield higher rents per square foot, thereby boosting the property's value. We aim for a minimum of an 18% IRR. Second question. Why should they invest in YD Development? Yuri and I had both been in real estate for a number of years. Yuri completed a ground-up condo all by herself, and I worked for a developer and managed my own property. Not exactly an extensive track record, but here's our unfair advantage. I did consulting for Common Living when the company was only 6 people. So by the time YD started fundraising, I knew co-living's business model inside out. I had ways to identify whether a building wouldn't work for co-living within minutes. I understood nuances about the business model and where co-living companies in general were headed in the long term. And I knew all this information before most people even knew what co-living was. And most of the people in New York City that knew what co-living was started to find out who YD was. I'm flexing a little bit here, but when you're doing a pitch, you need to instill confidence that the investor's money will grow safely with you. So be a little cocky. I'm not done answering David's question yet though. Another aspect of fundraising you have to think about is who do you raise money from? Not all investment dollars are made equal. You have to consider who is actually in your potential pool of investors. Just like your property search, you're gonna have to set some criteria, like check size and returns. For example, if you're purchasing a fourplex, you're probably raising from friends and family. If you're looking for a $10 million building, maybe a high net worth individual or a small family office. $100 million building? Probably a private fund or an eccentric billionaire. Know who your potential investors are so you're pitching to the right people. And the more institutional they are, the more competition you'll have, because institutional investors review deals all day long. Hold up, I'm not done answering David's question, because so far I've only covered equity. Raising money for real estate requires putting the entire capital stack together. Check out my video about the capital stack if you don't know what that means. You're gonna shop around for debt too. But this is not as complicated as equity. You can start talking to lenders before you have a property, but only to build your list of people to call when you're ready to buy something. There's not much to talk about beyond their basic rates if you don't have a property lined up. Just like equity, where you borrow from is dependent on your project's size. If it's on the smaller side, you may be able to finance it with a personal mortgage. There are plenty of lenders all across the spectrum to cover acquisition and construction loans. And just like equity, you're gonna have to answer those two questions again, although just slightly modified. What are they lending for, and why should they lend to you? Lenders are probably even stricter than equity investors because they have all sorts of metrics you need to maintain so that you're within their risk thresholds. The asset has to be able to secure the loan throughout your entire business plan. And your track record, balance sheet, and credit history are going to factor into whether you're creditworthy. Okay, I'll wrap this question up with two final thoughts. One, you can actually use equity and debt brokers to raise money for you. You'll have to pay a few percent for it though. And number two, there's actually so much to cover in this topic that I'm going to do another video on it later. But in the meantime, I hope this answers your question, David. Alright, time for runner-up questions. Jeremy Y.H. Kwok asked me as many questions as he could in one rambling comment. Best education or degree to become a property developer? Bachelor's in something practical that fits your personality. Does a degree in construction management or law help to become a property developer? Yes. And legal loopholes in property development? Lawsuits? How to work the local system to increase density? Get variances? Challenge neighbors? Zoning? DA approval? Taxation? Etc.? Hire a good expediter. Alright, next question from Jay Lee. What would be the most important attribute for a real estate developer and how do you improve that quality? Deal-making ability. Practice. Next question from Anna Jones. Do you invest in crypto and what is your net worth? Yes, as of this filming I have $7